Blockchain.com is trying to put leveraged futures inside self-custody instead of making traders hand their coins to an exchange first. This matters because perpetual futures are one of crypto's busiest products, but they usually require users to move collateral to a third party. This rollout tries to cut that step out. The key distinction is whether this becomes a real usage story or stays only an access headline. The feature routes through Hyperliquid and opens access to more than 190 markets with up to 40x leverage. Users can fund positions directly from BTC held in the wallet in a single transaction. For searches like Blockchain.com brings Perpetual, this matters because perpetual futures are one of crypto's busiest products, but they usually require users to move collateral to a third party. This rollout tries to cut that step out. Those are the confirmed pieces, and they explain exactly what changed for users right now. The company also signaled plans to expand beyond crypto into other asset classes over time. Perpetual futures let traders hold leveraged exposure without an expiry date. The new angle here is that execution is connected to a self-custody wallet rather than a conventional exchange deposit flow. Perpetual futures are leveraged contracts with no expiry date, and self-custody means the user keeps control of private keys. In plain language, the product is trying to remove steps that used to slow people down. That affects active traders who want high-speed derivatives access while still controlling private keys, and it matters for the broader push to bring advanced trading into wallet-native environments. The appeal is convenience, because the new route removes steps that previously kept many users out. That is often enough to create a burst of interest even before deeper adoption data arrives. The main uncertainty is how this model scales under risk, regulation, and liquidity stress once more users try to trade complex products from self-custody interfaces. Blockchain.com brings Perpetual is the phrase tied to this setup, and the main uncertainty is how this model scales under risk, regulation, and liquidity stress once more users try to trade complex products from self-custody interfaces. That uncertainty matters because launch campaigns, fee holidays, and headline attention can all look bigger than the steady demand underneath them. That distinction matters here. An access event is not always an adoption event. A platform can open the door instantly, while real user behavior takes much longer to prove. The strongest launches are the ones that still show activity after the promotion period ends. Watch whether self-custodied perps become a real competitive category and whether more traders accept wallet-based leverage as practical instead of experimental. That is the cleanest way to tell whether this becomes routine usage or just an attention spike. The next useful signal is not the announcement itself. It is the behavior that follows the announcement. The broader angle is that crypto products keep trying to hide complexity behind simpler interfaces. When that works, distribution expands. When it fails, the headline fades faster than the product itself. This story sits right in the middle of that test, which is why early traction has to be read carefully. For searches like Blockchain.com brings Perpetual, watch whether self-custodied perps become a real competitive category and whether more traders accept wallet-based leverage as practical instead of experimental. The story only gets stronger if users, volume, or developers keep showing up after the first announcement wave, because that is when convenience turns into real market traction.